Okay, great. We are live. This is Ariel Serber. I'm with Andy Wang and Guy Berger. We're going to talk about the Fed meeting and decision and sort of not just the top line, but like kind of what's under the hood, because I think that's obviously more important and what it tells us about obviously inflation, the labor market, and that really touches everything. So. Um, but first, if you guys want to introduce yourselves a little, and then we'll get into the conversation. Andy, go first. Go ahead. Go ahead.
Okay, fine. Andy Wong, managing partner at Runnymede Capital Management. We are a fee-only registered investment advisor in New Jersey. I'm also host of the Inspired Money podcast.
Yeah.
Guy Berger, a longtime fan and participant in Ariel's get-togethers. I am a labor economist, and I approach most of the Fed stuff mostly with an eye toward what's happening in the labor market. I'm a senior fellow at the Burning Glass Institute and economist at residence at Guild.
That's amazing. So we were talking a little bit about, before we went live, about today. It's obviously part of much bigger stories than just the Fed. There's a lot of things going on. But can you just maybe start with Guy, give us your feeling on how today's the rate cut, it was cut 25 basis points. So it's not a huge cut. It's not a huge signal of everything's falling apart. Though there was dissent. So Guy, if you want to get into that.
Yeah, sure. I'd say the thing that stands out to me, again, I don't think there's anything really surprising here. Relative to the last meeting in late July, essentially what's happened is the labor market data has been somewhat worse. Then the trajectory of the labor market data looks somewhat worse than it did. Not way worse, but I think Chairman Powell was kind of emphasizing stability in late July, and now I don't think he can say that. You see it in the statement. You see it in the projections now have a slightly, that essentially like, they expect unemployment to keep worsening. They think the risks have gone up. And you heard it in his press conference, which I thought was interesting because he really emphasized there wasn't a lot, I think, of like, oh my gosh, I'm so worried about the labor market and where it is right now. He emphasized it was a risk management or insurance cut. Like what the Fed wants to head off is like any sort of large, rapid cooling in the labor market that causes employment to suddenly fall sharply or cause the unemployment rate to rocket up. I think they're going to have some tolerance in the near term for the labor market getting a little worse. Essentially, that is baked into their forecast. It may entail a small amount of additional cuts. I think, though, he also emphasized that like there's no rush to ease by large amounts. He sort of emphasized, we might do more. It depends on the data. This did not sound to me like somebody who's very worried.
Right. Andy, what do you think?
Well, I think just for context, this is a Fed that coming out of the pandemic, there were tremendous concerns about what's happening in the economy. The Fed eased, pumped some liquidity into the system. We had stimulus checks, so people had money to spend. It supported the economy. Then for how long now have economists been trying to predict when is the recession happening? And to Powell's credit and the Fed's credit, so far they have been able to, fly the plane for this soft landing. I think to many of us, kind of a miracle. So kudos to them. Now you have this perfect storm or you have a very unusual time. And Powell talked about this during his statement, saying that normally, if you have a weak labor market, you also usually have less demand and less inflation. But this is a strange time because his dual mandate of, keeping a maximum job market as well as keeping prices stable, he's got a weakening job market, but inflation is still there. So the expectation coming into this, I mean, I think it was the market was pricing in 96% chance of a quarter rate cut, only a 6% chance of a 50 basis point rate cut. So Powell today, he said, we judged it appropriate at this meeting to take another step toward a more neutral policy stance. With today's decision, we remain well positioned to respond in a timely way to potential economic developments. So I agree with Guy. Powell sounds that he's in a comfortable spot. They've made an adjustment with the quarter point cut, but he feels like he has flexibility depending on what comes down the pike, that he can still, he has levers that he can adjust.
Yeah, absolutely. And to note, I mean, it's already September, and I think they in the statement they said there would probably be 2 more rate cuts this year. So there's really not many months left this year. I'm sorry sorry everybody, but the year's basically over. We're basically doing Christmas decorations at the mall already. Dana, welcome. You're in LA and looks like beautiful weather. Why don't you introduce yourself and give us your thoughts on some of the sort of top line info that's come out today.
That's coming out of Super Return West. Thanks so much. Good to see you again, Ariel, and the team, Guy, everyone. I'm Dana Fields, Chief Correspondent with Reorg Research, now Octus. We're owned by Primera Private Equity, sold by BC Partners, and we offer news, data, and intelligence for institutional debt and equity investors. Super Return West is a really great conference for lower middle market institutional investors. I led a few panels yesterday and the day before on private credit trends, a little bit on asset-based lending and real estate housing market. Certainly, and that was before today's meeting. Folks are really excited and eager, looking forward to some rate cuts. It looks like we got a quarter 25 bips drop, and overall, I'm still processing that myself, but there goes any inclination that it might be up to 50 bips. I kind of have been saying all year long that they'll probably start small, and you don't want to come in with a weed whacker and drop 25 bips at a time. I think there is still hope for another cut later this year, but investors at the conference are excited about the fact of rate cuts greasing the wheels, so to speak, for the housing market, greasing the wheels for the M&A markets, making debt a little cheaper so that folks can so that private equity firms can offer a bit more on the assets that they're bidding for. And on the housing side, a lot of folks kind of would-be homeowners remaining on the sidelines these past few years, getting excited about the potential of stepping into the game. And I know developers are interested and excited about that too. But yeah, small news today, but it headed in the right direction.
Yeah, no, that's interesting. I definitely think there's a few things we have to talk about because, the dual mandate and I think the new nominee or the new entrant to the Fed board spoke at his confirmation hearing about a third mandate, which seems to me kind of contradictory to the other two, because I think what my understanding of this third mandate is that you have to keep interest rates relatively stable. Is that accurate? Am I right or wrong? Am I taking crazy pills?
I mean, I think the argument has been for the last few decades of how the Fed has interpreted this legislation. The best way to guarantee moderate long-term interest rates is to hit the other two mandates. And I guess what I would say is this renewed interest in this mandate, I don't know, kind of suggests sort of a way to try to wiggle out of addressing. I'm trying not to be too cynical, but I mean, given its sudden emergence during a period where powerful people are urging very large, rapid cuts, won't name names. I think that this is sort of an attempt to try to square that circle, whether it works or not. I'm just like, that's my read on it. Normally just ignored until recently. Ignored in the sense that the assumption is you're going to get there. as long as you deliver on the other two mandates.
Right. If you do the job, it'll happen. It'll be inherent in the outcome.
Yep.
Yeah, that was mentioned in the Q&A. And
Okay.
And Powell said that the Fed doesn't treat that third mandate, moderate long-term interest rates, as a separate goal. And just as Guy said, they think of it as a dual mandate, maximum employment, price stability. And they think that moderate long-term interest rates are something that will result from stable inflation, low and stable inflation, and maximum employment. So they haven't really thought about it for a really long time as a third mandate, because it doesn't require independent action.
Yeah, it's inherent in the other part of it. And what about, look, I'm just getting my news from you guys. And I think Dana is as well. What about, did they say anything specifically about tariffs? Or was it more just couched in kind of inflation talk?
I'll go really quickly. They did address tariffs. Powell addressed tariffs, saying that he's watching tariffs closely. But the data that they look at, I think the Fed's assumption is that two things. One is that they believe that a lot of the tariffs so far to date have been absorbed by corporations and passed on to consumers on a limited basis. Many companies have been talking about that they will pass it on to the consumer eventually. Many retailers have talked about passing like 100% of it onto consumers, but that has yet to be seen. I don't know that they'll be able to do that. But one thing that Powell did say is he mentioned that the Fed is expecting a little price increase as a result of tariffs, but they kind of see it as a one-time thing, not resulting in like a persistent inflation. And I defer to the panelists.
Why do they see it?
Why do they see it that way? Because once the tariffs are implemented, it's not a one-time thing. It would be ongoing. Wouldn't that, if it results in higher prices to the consumer, why would it be a one-time thing?
Well, it would be. I mean, the way the Fed tends to think about it, and they're like, Fed has done research on this a lot in the 2010s during the prior Trump administration, where again tariffs were a big talk, like it happened too. Is the way they sort of think about it is you have this period of inflation as prices adjust to the new level, then prices stay at the new level, at least in this thing, and so you will get measured inflation that's higher for a period, and then you settle back to the old inflation pattern afterwards. In fact, Powell's emphasized, and I think it is a reasonable base case, where he says, listen, people are saying that we should, ignore the tariffs. We are functionally ignoring the tariffs impact on inflation, because if we were taking it very literally, we'd be raising rates right now, because there is going to be this short, think about it as like almost like this snake python swallowing a giant egg or something, or swallowing a goat or whatever your favorite thing is. Like, there's going to be this short-term
none of that.
And short-term is a very loose term. Like, I think this is something that could be playing out for 12 to 18 months. But if you look ahead 2 to 3 years, any impact on like year-to-year inflation will be in the rear view mirror. There are huge question marks about that, candidly. Like, one school of thought is like, you know what if these increases stick? And then on the flip side is sort of the Scott Bessent view, which is, listen, Bessent wouldn't say it this way, but like, a tariff's a tax hike. What happens when you hike taxes? You slow down the economy, and what happens when the economy weakens? You actually lower inflation. I do not think that is, as far as a view 2-3 years out, I don't think that's a crazy view on what the tariffs might do, but it's all very uncertain. And the Fed's basically telling us we actually we're not really going to have a great idea what inflation's trajectory is for quite a while.
Right. Augustus, welcome.
Hey, sorry I'm late.
No, look, it's come as you are, when you are, come and go. Why don't you introduce yourself and give us your thoughts on today and just general state of play, state of the economy?
All right. Well, I'm a founder and CEO of Share Scoops. We're a financial news and education platform. Also former multi-asset portfolio manager at JP Morgan before I left, and just trying to make the financial world more accessible. So trying to help people understand in simple terms what this big macro stuff and things happen in the stock market means for them. So today, lots of thoughts. What have we touched on so far? I don't want to.
Whatever's your, I want your perspective. Just what's your perspective on, what does the 25? So, okay, so I'll take it a step back. You just said you're trying to do things so that, what was the last thing you said? You said it was about making sure that people understand like what these things within the market mean,
what your average
for them.
person, your small business
So what
owner,
does this mean for the average person? 25 basis points. What does that mean?
Well, I think that's the big question. Does it mean that much, right? I think, what the main things that people are looking at right now is your home. When I get asked about interest rates, it's mortgage rates. And that's a good question. Is this really going to be something that shifts the housing market? I mean, it feels like the most tangible area where interest rates have had the most visible effect in actually slowing stuff down, right? That basically home sales, new home sales, existing home sales have all stalled. Home prices have, stopped inflating to the same degree. So the question, and a lot of that is focused around mortgage rates. So the question is that really going to change that much to a degree that it changes the activity in the housing market? I don't know. I mean, most people are locked in. I think what's average is, somewhere around 4 or 5%. I think we're 1 or 2% away from, your average mortgage. And then, you've got 80% or so that are under 5%. So it's a while before people are really seeing more.
If people have a mortgage at all, because a lot of
people
have a
mortgage at all,
been in their home for a long time.
The whole sort of, retire, downsize, sell your home, downsize, live off the, money kind of strategy. A lot of the retirees are not really doing that much these days. It's not even just mortgage rates, right? It's larger property taxes, HOA fees, insurance costs that are really high. So is this going to change the most tangible thing about home prices? I don't know yet. And also, as we all know, it's not really a direct impact on it seems like, the Fed isn't influencing long-term rates in the same way that it used to, right?
Well, I think it's interesting, Augustus, and maybe you could touch on a bit and there's kind of a shift away from home ownership. Obviously, everyone needs somewhere to live. So that would tell me that there's a big investment opportunity in the housing rental space. I mean, how does the average consumer capitalize on that if they wanted to maybe look at their portfolio, maybe their 401k or their REITs or something? Or do you have any advice for folks looking in that direction?
I don't know if the shift away from home ownership is intentional or by choice
I don't think it's by choice, but I do think it's become harder and harder to own a home to reach that.
Definitely. Well, I think some of even the stats that are coming out a lot conversations about the consumer. You have to really start to talk about which consumer, and it's becoming more and more sort of two different, very clear stories. I think it was like Odd Lots really said this really well this week, but the stats from I think Moody's that the top 10% of incomes accounted for half of all consumption spending over the past year, and so up from 20 or so, 20-30% decades ago. So there's a different, and then the article that Lots highlighted, so I don't take all credit for this, but I think it's the New York Times and Disney shifting their high price focus to more of the affluent market. You're seeing it with different, the airlines all talking about how they're shifting more to premium. You got even Spirit coming out of bankruptcy, shifting to premium, giving up on budget shoppers. So I think a lot of, just like homes, so much of the economy is shifting towards sort of discretionary spending being catered towards the affluent. And it's becoming two kind of very different markets, but that's kind of a separate conversation.
It's a whole other thing. James Eagle joined, so that made us international. Welcome, James.
Hi, guys.
Do you want to introduce yourself?
How are you? Hi, I'm James Eagle. I've worked in the asset management industry for about 20 years. what can I say? I'm better known for my data visualizations. If you see my stuff online, if you see a little logo called Eagly, that's me. Recently, it's changed to Plotset because Plotset's a new startup that I'm helping launch, which will allow people to do what I do. But a lot of what I do is financial related. So a mixture of kind of asset management and wealth management pieces. I work with a lot of US groups as well. So Vanguard, JP Morgan, to name a few, Fidelity, my old employer. So yeah, that's me.
Yeah, and what are your thoughts? I sent you a message because I saw you posted. I didn't even read your post.
Something, right? You didn't read it.
But like,
about the Fed cut, right? About the Fed cut.
Yeah.
I mean, it was kind of expected. So I would say, like, let me just have a look at my post, and I'll paraphrase some of the things I've written there. I mean,
first of all, you spelled labor wrong.
Yeah, I did. I like to test
British
you,
version.
I like to test you. Yeah. I like to put. Well, we use a different dictionary. So, yeah. So, I mean, the labour market is losing momentum. That's the key issue, and I think that's something that that we need to bear in mind. That was a key driver to this rate cut. I mean, as soon as those very weak labour numbers came out, a cut was on the cards. Core inflation is also worrying. It's drifted higher. It's still not really where it should be, and there's political pressure, which is no longer just background noise. So there's a lot to untangle here. It's a modest cut. It signals that the central bank is being pushed towards an easing cycle, even as inflation sits above target. And also, the decision wasn't unanimous. So Stephen Moran wanted a 0.5 point move, actually. So that was quite interesting. And
not just at this meeting, he wants 0.5 point cuts every meeting for the remainder of the year.
Yeah, I mean, that's his position. That's what he believes. I mean, I'm not trying to take a political position here. I mean, I'm a Brit, so by default, I'm bipartisan, and I don't have an interest so much in the politics.
You're literally Switzerland, aren't you?
Yeah, I'm in Switzerland, but I'm British. I mean, for me,
I know. I'm saying you're neutral.
Yeah, I'm neutral, I guess, but I'm not Swiss. But I would say that, like, for everyone outside of the US, we want a robust US economy. It's very important that we have certainty, and we have and that the United States remains strong, both economically and geopolitically. So for us, it's very important that we have a stable United States. So that's why, for me, I look at US data, because it's very important to my life. I generate a sizable amount of revenue from the US, and yeah, I mean, I would say that I prefer. I hope that policy decisions should be, in my opinion, they should be data led. So if payrolls and hours work soften again, another 0.25 point move is justified. If core inflation accelerates, then they should pause. The committee needs to resist the temptation to pre-commit. Secondly, speaking plainly about tariffs and immigration rules, tariffs add to costs. Tighter immigration slows labor force growth. Both complicate a clean kind of disinflation environment. So the Fed cannot set trade on migration policy, but it can show what the effects are. Third, it needs to defend its process. That's really important right now. So the central bank's independence is not a ceremonial phrase. It's the reason inflation expectations remain anchored when politics runs hot. If the public concludes that rate decisions answer to the White House, the long-term cost will be far greater than any benefit from a few quick cuts. We cannot afford for the Fed to lose credibility here. I mean, we saw quite a big blip in the US dollar market just now. I mean, the dollar depreciated very rapidly and reappreciated intraday and ended flat. these things, I saw that on Twitter. I didn't really pay much attention to it, but it's interesting when you see those little blips. So,
Andy, what does that tell you? And what do you tell clients if they have a question about that?
What does that tell me? I think it's curious that Stephen Myron, the new addition at the Fed, he also wrote a paper which has become known as the Mar-a-Lago Accord, in which he wrote about really wanting to have a weak dollar. All the experts that I talked to earlier this year, because that paper was being circulated, and I was curious, do people really believe that the United States wants to implement this policy? And people much smarter than me, like guys who are managing sizable hedge funds, they tell me, no, that would be stupid. There's no way they want a dollar that is that weak. It would be bad for the stock market. It would be bad for our economy. But the fact that Stephen Myron has been added to the Fed, lots of questions. It leaves me.
Andy, it's quite funny because he's kind of backed away from that paper a little bit. I don't know if you've noticed that. So I think he wrote that paper before he rose to prominence. So he wasn't, and now I think he's slightly changed his tone on that position, which I thought was very interesting. You're much more knowledgeable in this area than me, but I just don't know. It's just bizarre. I'm sure he's a very intelligent man, but I'm sure there are far more competent people out there with a little bit more experience that should probably be in that role. But that's just an outside observation.
I think there are a lot.
That's like the third. You're touching the third rail here.
Yeah,
Guy,
I think.
What do you think?
Yeah, I'm an economist, not a politics person, so take all this with a grain of salt. But just reflecting on what James said, which I think is right. Like, the Fed's not some sort of the Fed has influence on the economy, but a lot of it depends on the Fed being able to move forces in the economy that doesn't itself control and react to them effectively. And the whole credibility point, like, the key thing is that you want the Fed to be able to be in a position that even though they only control short-term policy rates, they can help maneuver long-term rates to what is good for the economy. And if the Fed behaves in a way like that compromises that link, which is, by the way, what would happen if the Fed started easing monetary policy a lot during a time when inflation is generating upward pressure, which may or may not be happening. It's above target. There's some reason to worry about it a little bit, but it's early and the tariffs are a measurement. But again, I don't think that you could easily manage a situation where the Fed is just easing because they want to boost the economy and they're just ignoring inflation. Not the case right now, but I think I'm fast forwarding scenarios a year or two in the future, and mortgage rates are moving in the opposite direction because they're building up 3, 4, 5% inflation in the future. And I think that's, I would not say it's necessarily the base. I don't know. It's something that is sort of hovering in the back of my mind. At what point would I get worried about it? And are we getting closer to that scenario? I do think so. The current members of the Fed are generally resistant to that, but there are going to be future appointments to the Fed. There's an attempt to fire one of the existing governors. Powell.
Well, Powell's term is going to be over.
He could stay as on the board, by the way. His term as chair is over, and the chair is powerful, but the chair is not, the only person there. But every 2 years, somebody's term is up. So at some point, there's going to be opportunity to replace more people.
I have a question, if I could throw it out here.
Yeah.
Turn West, AI has been a really big topic, and I've moderated a few panels. I always like to end my panels with the mega question amongst asset managers and private credit managers. Are you hiring? Are you hiring this year? Have you been hiring this year? What does 2026 look for next year? And a good number of them said instead of hiring college grads, they have found ways to replace that work. Andy is nodding his head. I'd like to get your opinion on it, with AI and with automated efficiencies. And, we're only at 1.0 version of that. So over the next few years, I see the use of AI becoming more and more prevalent amongst financial services firms. So if we have continued weakened job reports for the rest of for next year, how will that affect the economy, and your view on rate cuts? Andy, what do you think?
Well, I started this conversation by saying that the Fed had this like enormous job to do because of the pandemic, like something that we had never seen in our lifetimes. But I think now we're seeing this perfect storm of tariffs that we haven't seen in 100 years, plus AI. I mean, there's an AI revolution happening. And I think this level of uncertainty, not only for investors, but for the Fed, it's reflected in the dispersion of opinions. 10 out of 19 participants project 2 or more cuts for the rest of the year. 9 participants project fewer or even no additional cuts in 2025. Chairman Powell did frame this dispersion today as natural, given the historical unusual situation. He specifically pointed to 2-sided risks, which is you have inflation still above their target, but you also have the labor market weakening. I think he also clarified saying that this is the first time that the Fed is starting to see a little bit more risk in the labor market rather than inflation, even though they acknowledge that inflation is there and it's high, but they kind of think that they're projecting that later this year, inflation may still be a little bit high, like at 2.9%, but then it should start coming down. So they're less worried about inflation right now.
Can I?
Yeah,
I jump in.
I think they are worried about inflation, but the Fed has a dual mandate, so it makes it a little bit awkward for them. So right now, the greater concern is about labor, not inflation. But they are concerned about inflation, but they just need to focus now on the labor market.
But AI is AI is a big question.
And actually, I want to address Dana's point very, very specifically. So, like, if you look at the Fed's projections, they basically expect unemployment rate to drift up a little more. They finish the year at around 4.5%, and then just start drifting back down. If we keep, and I think that sort of entails a few more jobs reports for the rest of the year, like the ones we've gotten, where the unemployment rate creeps up a little bit each month. 4.5% is still a little bit of a ways to go. Like, you won't get there. I mean, if we get there next month, then they're going to be easing a lot more than 25. But I think the question is what happens after this. Like, I guess, so to frame yours, let's say that AI I think AI's role in weakening the labor market, in my opinion, is exists, but I think it's somewhat overplayed. However, let's say the unemployment does keep drifting up next year. And again, it depends on what inflation does. If inflation totally goes haywire, that offsets this. But like, if you were to tell me, Guy, the unemployment rate's going to reach 4.5%, and then next year it's going to be at like 5.2%, like it's going to be heading toward that, the Fed's going to be easing more than they currently have planned. Like, that's sort of it. You just assumed right now what they're conditioned on is inflation rising somewhat due to tariffs, but not in a way that doesn't suggest rises after we sort of swallow the tariff egg, or tariff go, if I use my Python thing, and unemployment rate only rising a little bit, but not too much.
I do think that you're not going to see a drastic move in the reduction of jobs because of AI, to your point. I think it will be gradual, but I think, if every firm is talking about replacing a couple of college grads next year, that does add up over time. And that's, again, just the beginning. So those job numbers are very concerning to me. And I feel like we'll have a pretty big impact on rates and the direction they go.
Yeah, and I saw a couple of things about the long-term unemployment rates, meaning people are unemployed for longer now, and it's hitting college graduates more than it ever did. There was a article in the Times about that as well. So, look, there's a lot to obviously keep our eyes on. The simulation is kind of going crazy.
And as a college grad of 2008, I majored in newspaper editorial and came out during the largest financial crisis. I cannot believe they sold me that degree. And that was before learning about how to write for the internet and multimedia, things like. It was rough. It was a rough go. I was looking back at the numbers. By 2009, we had 10 or 11% unemployment. I remember working at Loehmann's department store in retail for a good year and a half before I got my break as a copy editor and moved up as a reporter and kind of went in that direction. So if we do have college grads listening to us today, as far as how it's affecting the real world average person, I would suggest finding that niche where you can offer value, however small it was. I do remember taking an unpaid internship. Those were quite common in 2008 and 2009. But whatever you can do to get your foot in the door, whoever you can speak to, I think I way underutilized my contacts, my parents' contacts, my neighbors' contacts, who's ever in your direct vicinity in your neighborhood. But it's going to be a very competitive job market for those in their early 20s, and you're going to have to find that niche, that value add, wherever you can. You should lean in hard. And if anyone has advice,
no, that's a great point. I think that's. Sorry, Dana. I think I stepped on. You were about to ask, what can people do in this environment? And I think that's an important question to maybe wrap up with if we want to go around the horn and start with Augustus.
Yeah, I'll have to. My company, we're FinTech. We build with AI, so we are, watching this. I'm watching this very quickly, very closely, how quickly it is evolving, and I think that's something that plays into these projections as well, right? That there's uncertainty. These companies, no, it's moving faster. It's so hard to even keep up with how quickly this technology is developing, and companies trying to forecast that or integrate it into what their hiring plans are, or how they're going to adapt to it, or even just training people to be able to use it is going to be something that, it could be a net job creator in a lot of ways in a lot of industries, as it becomes, people become more managerial of AI agents, but those kinds of things are going to take time. So I think it creates a lot of that uncertainty within the labor market. And I think to the questions about like where the Fed, is thinking and what they're prioritizing, I don't understand this sort of shift. It seems like these are more signs of the risk of political pressure. Because if you look at what was it 2 years ago? Powell was ready to push us back into a recession to bring inflation down. He was the fact that we're sort of switching to the other side of the mandate all of a sudden, it doesn't really seem to align with what they're even saying. If you look at the projections that they put out, their projections were hawkish. They're forecasting higher. They increased their GDP forecast, increased their inflation forecast, and decreased their unemployment rate forecast. So it's all pretty hawkish, but at the same time, they're cutting rates and saying that they're more concerned about the labor market when they're forecasting lower unemployment. So it's it feels like this is a little bit more of a safety play from a political standpoint, which has repercussions. Even JP Morgan, their latest note, was advising their clients, which are the largest clients in the world, billions of funds, to be diversified across global government bonds, and that's billions in funds that are advising away from U.S. Treasury. So these kinds of things can definitely have an impact.
Yeah, and James, you were speaking about that before with the dollar and everything. So,
I mean, I would say, like, if you're a young graduate right now, first of all, don't over rely on using AI to write your resume. That's a really important thing. Employers notice that it's a competitive market, and right now, what's happened, like you see in markets, is that you're getting a lot of noise. So just like in the stock market, where there's a lot of noise and it's very hard to see signals, it's the same thing for an employer. So if I have a stack of resumes in front of me, I've got to sift through that, and I've got to figure out what's real, what's not, what stands out, what doesn't. And if you use AI, you might not stand out so much. So that's a really important thing. I think you need to bear that in mind. I would also say that the labor market's complex. There's a lot of factors at play right now that are affecting jobs numbers, and it's not necessarily. Obviously, AI is one factor. So there is and how that plays out is very, very difficult to predict because we're too early on in this journey. But it could completely restructure the white collar market. But I would say also there are other forces at play in the labor market, like the last time I was in the US in August, I was walking around and in Boston, and I was just seeing, signs everywhere saying we have vacancies, we're hiring, we're hiring. You don't see that in Europe. You see it in the US, and that shows that there's something going on that is not being reported in the data. That there is generally a shortage of labor in certain parts of the US, and there's a surplus in other parts. So I think it's quite uneven. That's just my kind of general observation that I see.
Yeah.
So I'd say that there may be problems in the labor market, but it seems to be two-speed, just from casual observation. And I think also, this is something I always tell my kids as well. So even if you're a graduate, in 20 years' time, you may be doing a job that doesn't exist today. That's just another thing. So when you go into the job market, progress is never linear. And you only realize that if you're 20 years into your career, that you do a variety of work and go through a variety of different roles. So never go with the mindset that you're going to work for a company for the rest of your life and get a pension and retire. It just doesn't work like that anymore.
Doesn't exist.
Yeah. So those just come 3 random thoughts on the topic.
No, that's great. Thank you.
I just want to piggyback on just real quick, because I know we're on a time crunch, but I completely agree that employers will know, just like your professors will know, if you're using AI, right, to write a paper or to write your resume, it stands out like a sore thumb.
Yeah.
But the smarter way to go about it is to be and illustrate in your resume that you are that person who uses AI, who knows how to use AI to do this job better. That you should absolutely get across in the resume that you write yourself. So if you're a software engineer worried about being a college educated, recent grad software engineer worried about being replaced with automated processes, take an AI boot camp, explain how you use AI to improve efficiencies in your coding, in your structuring of code, in your problem solving, and apply that to all the sectors as well. If you're a writer or a journalist, how you're using AI to dig deeper into trends, to dig deeper into data, to pull out those themes, and being a real expert at enhancing your skills via AI is absolutely wanted, right? That will get you hired.
Thanks, Dana. Guy?
Yeah, sure. So I'll take a slightly, let's call it a slightly different angle here. The first is that I think, again, I'm just looking at the data that I see. I think that this is a bad job market for college grads is sort of a story about, it's still true, but I actually don't see super clear signs that it's still getting worse. In the current year, it doesn't seem to have gotten worse. And instead what we're seeing is like a lot of weakness in the job market for like young high school grads, people with associate degrees. Like about a year ago, young people with associate degree was this weird, super strong core. Weird in the sense that like it was a very strong corner of the labor market. It's gotten a lot weaker in the past year, and I don't know whether it's AI spreading into industries that people with associate degree have, or I think somewhat more likely just a cyclical weakening of the economy that's weakening different parts of the labor market at different times. But I would just say, in general, if you have, for example, somebody that you know that's going to community college or just about to start work after finishing high school, they're going to encounter a very different environment than 2 years ago. It's going to be hard. I think that regarding college students, I really like Dana's advice and I like James' advice. I think a lot of it is, I actually think that if you think about it, we used to think of university as being very slow to adapt. But I would say that out of all parts of our educational system, it's probably one of the ones that is most, in terms of teaching people marketable skills, it actually adapts in a more methodical way. And so I'm pretty convinced that the AI savvy talent of the future, that is the backbone of the workforce, is going to come from the university system as well. It's just the nature of this thing. Again, curricula will adapt. Universities will start thinking of AI less as a threat in terms of people cheating at exams. I mean, that is a problem they're going to have to deal with, and more in how can you enhance curricula and make people better, productive members of society using those skills. And I actually think that's the worries of people being left. The story so far is, people that have high school diplomas are insulated from AI. At some point, technology is going to affect those, and I think we're going to have to think about curricula for those folks, it also makes them
Right.
able to use AI effectively. And so I feel for today's college grads, it's hard. Fortunately, at the moment, it does not seem to be getting harder, unlike their peers with associate degrees in high school.
Yeah.
But like, I mean, if you think 5 years ahead, 10 years ahead, I'm a little more skeptical that we're still going to be talking about a really tough, like that college grads and universities will adapt. It takes time, but it'll happen.
Yeah.
It always
And
has to.
Andy and I have, sorry, but Andy and I have high school seniors, so we're thinking about, you know, the next thing, college and beyond. But I think if you have an attitude where you keep learning and keep growing, but I want Andy to speak, and then I'll wrap up.
Okay, I'll just bring it back to the Fed. I mean, the Fed is split. Some see a need to ease further if jobs keep weakening, while others want to hold steady until inflation comes down more decisively. I think from my client's standpoint, I see like a wide dispersion too. And maybe it's because we're in this like politically divisive climate, but I have clients who think the world is about to end and they want to be in all cash and gold. I also have clients who think that the economy is great and they want to own more NVIDIA. So everybody's split. Investors are split. The Fed is split. I think if we look at what the market is telling us, this is where I'll leave it today. I mean, if you look at the last few weeks, consumer discretionary stocks are doing better than consumer staples. Bitcoin is doing well. Big tech is still doing well. That is a risk-on environment. So the market does not see a big correction yet. There has been some broadening of the market rally. So we've seen small cap companies acting better than they did last year when they were massively underperforming big tech companies. So I think that risk on is still going, and try to follow the market, stay diversified, because as the Fed is split, the uncertainty could keep markets volatile around each economic data release that we see.
Yeah, and there's data released like every day. So, and that's part of what we talk about on LinkedIn. And I'm so glad you guys all came and showed up. And please follow one another if you don't already. If you're not following just between the 6 of us, please fix that and keep engaging and keep learning from one another. I think that's kind of the key. It's one of those things where you hear, you can what's the phrase? You have it could be 10 years, but you had the same year 10 times. So make sure we don't do that. And that's part of the you see right here, I've got the apples and honey. That's the Jewish New Year is coming up. So Shana Tova and Happy New Year to all celebrating. And we'll try to run it back next time. We'll see what happens in the next month and what it tells us.
Is it on Halloween? After? Before? What's the specific date?
Halloween? No. It's next Monday night.
No, not Rosh Hashanah. The next Fed meeting.
Yeah.
Come on.
Oh. I don't know. I have to look it up.
All right. Well,
I'm just looking it up.
I thought you meant Rosh Hashanah too. I'm like, Guy, if you want
I
to celebrate,
do, but
come on
like
over.
I didn't. I was not talking about. Sometimes the lunar calendar is weird. At some point in like 50,000 years, it probably will
Sometimes
be
it's very late.
costume Rosh
True.
Hashanah. Spooky Rosh Hashanah.
Sometimes very late.
Yeah, it looks like October
right.
28th, 29th. The Chinese, we
Ooh.
use a lunar calendar too, so it's very confusing. My dad celebrates 2 birthdays.
Right.
Oh, so I have 2 birthdays. Yeah, you have a Hebrew birthday. I have a Hebrew birthday and an English birthday. Good stuff.
2 names as well.
Amazing.
That's
All right, guys.
Thanks all.
Thank you so much. Go enjoy your day, and
Thank you
we'll
so much.
keep engaging. Take care.
Take
Bye,
care.
guys.
See you, everybody.
Thank you, everyone.